I would like to discuss how to use price to earning ratios to evaluate value stocks. How to use price to earning ratios or PE ratios to evaluate value stocks. So in this case, we talk about number one, the introduction to PE ratios. Introduction to PE ratios. The price to earning ratios is a key evaluation matrix that compares companies' earning share price, companies' current share price to its earning per shares. It compares the share price, by the company's earnings per share. It helps investors assess whether a stock is undervalued, overvalued, or fairly priced relative to its earnings. Number two is how PE ratio is calculated. How PE ratio is calculated. The PE ratio is calculated by dividing the stock current market price, you divide it by the earning per shares. All right, the company's current market price divided by its earning per shares. Example, even the stock is trading at let's say $50, all right, and the earning per share is $5. So you divide 50 by 5, that will give you 10. So in this case, we have a PE ratio of 10. So number three, PE ratio interpretation. How do you interpret PE ratio? PE ratio interpretation. You've done your calculation, $5, $50 divided by $5, give you 10. So how do you interpret that particular value? So high PE ratios indicates that investors are willing to pay, more, for each dollar of earnings. They are willing to pay more for each dollar of the company's earnings. So often because they expect higher future growth. However, if for value stocks, this could indicate overvaluation. Generally, the higher the figure, the more the company is considered overvalued. The lower the figure, the more the company is considered undervalued. And so, not only that, for a low PE ratio, this suggests that the stock is undervalued or that the market, has low expectation for future growth. So value investors typically look for stocks with low PE ratios as they might present buying opportunities. And not only that, when the market corrects itself, investors will come to appreciate the value inherent in the typical low value stocks, and then the price will skyrockets. Number four, using PE ratios to evaluate value stocks. Using PE ratios to evaluate value stocks. In that case, there's a comparison with industry peers. You compare the figure with related figures in the same industries, the same sector. So a low PE ratio relative to the industry average can signal that a stock is undervalued. However, it's important to compare stock within the same sector, as PE ratios can vary across industries. You must carry out an apple-to-apple comparison, not an apple-to-orange comparison. You must compare the figure with those in the same sector, because these ratios tend to vary from sector to sector. And not only that, you consider a historical PE ratio comparison. Historical PE comparison. Compare the current PE ratio with the company's historical PE to assess whether the stock is cheaper than what it used to be in the past. Because if the PE ratio is, let's say 10, this year, compare it against last year. Okay, if it was higher last year, it means the stock is becoming cheaper. If it was lower last year, because if it was lower last year, it shows that the stock is becoming more expensive. So we carry out historical PE comparison. Then there is growth versus value. Growth versus value. So growth stocks generally have high PE ratios due to their high expected earnings. The earning growth is expected to be high. So value stocks, on the other hand, typically have lower PE ratios, making them more attractive to value investors looking for bargains. Number 5, limitation of the PE ratio. The PE ratio is not sacrosanct. It has limitations. And that's what we want to consider now. Limitations of the PE ratio. So there's this earnings volatility. The PE ratio can be misleading if a company's earnings are volatile or temporary, as it may exaggerate or mask the true value of the stock. That is it. So it is if the earnings is volatile, if there's a kind of higher earning as a result of sales of an extraordinary item, then that could be taken into consideration. So there's non-earning companies, companies that do not generate profit. Example, startups or some tech companies are just new into the market. They may not really generate profits and may have very high or undefined PE ratios, making it less useful. In a case where there is no profit, you can't calculate PE ratio because there must be that element of earnings for you to be able to calculate PE ratio. In that case, you will not be able to calculate PE ratio. It becomes irrelevant, becomes meaningless, because you can't determine the company's PE ratio because there's no profit, there's no earnings. So not only that, distorted by accounting practices. It can be distorted by accounting practices. Earnings can be influenced by accounting methods, which may distort the true financial performance of the company. It can be tinkered with by creative accounting, by someone say voodoo accounting. The P ratio can be manipulated. It can be distorted. Number 6, PE ratios in conjunction with other metrics. PE ratio in conjunction with or in combination with other metrics. PE ratios in combination with price to book ratios. So a low PE ratios combined with a low price to book ratios can further suggest that the stock is undervalued relative to its assets. Okay, apart from being undervalued in relation to its earning, it's equally undervalued in relation to its net asset value. So it's somewhat undervalued. Not only that, you could combine PE ratios with debt to equity ratio. So a high PE ratio might also be influenced by a company's level of debt. Consider using the debt to equity ratio to assess financial risk. So in this case, you combine debt to equity ratios with the PE ratio to assets. That will give you a better idea of how undervalued or overvalued the company is. You can equally combine it with free cash flow. You can use PE ratio in conjunction with free cash flow. So use free cash flow to assess whether the company's earnings are being converted into actual cash, which can provide a clearer picture of valuation. In some cases, a company may be profitable, all right, but may not be cash flow positive, all right. So the profit is not being adequately converted to cash. So don't just base your analysis on the PE ratio alone. Make sure that the amount generated is fully converted to cash. That will give you a clear picture, a better idea of the company's valuation. Please subscribe to this channel and like this video. Number 7, risk of over-reliance on PE ratio. Risk of over-reliance on PE ratio. In that case, it will lead to what is called value trap. A stock with a low PE ratio may seem undervalued, but if the earnings are in decline or the company is facing serious financial trouble, that could be considered as a value trap. Don't just look at the PE ratio alone. Look at the company's fundamentals. Are the earnings declining? All right, or is it facing financial trouble? Make sure that you avoid value traps. Not only that, you also look at the market cycles. In certain market conditions, example, recession or bear markets, even low PE stocks may continue to decline. So it's important to consider, the broader market trend. And in conclusion, the PE ratio is a valuable tool for identifying potential value stocks, especially when used in conjunction with other metrics and industry comparison. A low PE ratio can suggest undervaluation, but it's important to assess the underlying factors such as earning quality, market conditions, as other factors before making investment decisions, so that you not end up with a value trap.